Hey Next Economy Now listeners. Before we dive into today's episode, we have some exciting news to share. Our fall cohort of the Next Economy MBA begins on September 19th, 2023, and we want you to join us. We designed the Next Economy MBA for entrepreneurs and change makers who are helping to create a world that works for all life. During this 9-month program, you'll learn practical skills on how to transform your organization into one that is just, equitable, and regenerative. Plus, you'll join an alumni community of over 500 impact leaders who are transforming organizations around the world. Interested in learning more? Visit lifteconomy.com/MBA to view our course curriculum and sign up for a free intro session with our facilitators. Plus, you can save 20% on tuition where you register before July 24th. Thanks for listening, and now, on to the show.
Welcome to the MBA Series. This is a special multi-part series within Next Economy Now. We are going to review the arc of the learning journey that is presented in the Next Economy MBA online course. We are open sourcing the content from our course and hope to share it in this shorter, bite-sized format. We are launching this series because we were asked to do it by listeners like you. We're also doing it because we are writing a book entitled The Next Economy MBA, Redesigning Business for the Benefit of All Life, which will be published on May 23rd, 2023 by Barrett Kohler Publishers. This is a sizable series. There will eventually be 18 podcast episodes of course content and 9 interviews with MBA alumni. We will be rotating every other week with our normal Next Economy Now interview format. We hope you enjoy it. Please reach out to us via our website, lifteconomy.com, with any comments, feedback, or requests. And now, on with the show.
Hello, and welcome to Next Economy Now podcast special series on the Next Economy MBA. This is episode number 20 on operations to operating projection and financial systems. My name is Sean Barry. I am a partner at Lift Economy, and I'm here today with Kevin.
Hi, Kevin Bayuk, also partner, worker, owner at Lift Economy here. Always excited to talk about financial systems.
Yes. Well, welcome, Kevin. I'm glad you're with me because we actually do enjoy these things. And I was wondering if you could start by talking about what level of understanding are we looking for here when we introduce people to financial systems?
Yeah. So, I think one observation that we've had over the years is that when people come to bringing their values to producing needed goods and services for their community, a true next economy type endeavor, wanting to move away from what they've seen in the business as usual economy in terms of exploitation of people or planet and all the harms done from multinational corporations, maybe harms that they've experienced in different ways in their lived experience. There tends to be an aversion to wanting to have an understanding of financial systems. What do I mean by that? When we ask people in the training, what comes up for you when you hear the words profit and loss statement or balance sheet or something like that, the participants will always say emotionally, sometimes it's fear, anxiety, stress, or even disgust, anger. And so there's this regard for financial systems that creates a barrier from the get-go. And, I think it's healthy to acknowledge as a society that the development of the language of financial systems as a specialization has been wielded as a tool of oppression, as a way of concentrating power, because there is a language to financial systems, and it could feel like the Matrix or learning code or a foreign language, even if core aspects of financial systems like income comes in, expenses go out. Those might be really intuitive concepts. And for most people in their lived experience, they actually do accounting for their time or maybe their own personal budget, or whether it's money or around just resources in general. Like, I only have so much capacity or energy to be able to commit to such and such project. And so there's intuitive concepts that we do kind of have, most of us have kind of in our lived experience, but the language that is presented in the business as usual economy can be confusing. And because of and of course, not only just confusing, but bring up these horrible emotions. So one thing we see as a common pattern is this abdication of like, okay, I kind of know I need to have like bookkeeping, or I know I need to pay taxes or whatever. So I'm going to outsource that to somebody else. I don't even want to look at it. And that abdication, kind of that giving over to somebody else, unfortunately has the consequence of handing over a tremendous amount of power to another stakeholder, which that might work out, but that doesn't always work out. And we see that as potentially an overcorrection. There's another kind of reaction that happens besides abdication. Some people just don't look at it at all. They, refuse to do any double entry bookkeeping, and then they get stuck by when it comes time to pay taxes, or when it comes time to try to access credit or get a loan for their business or enterprise or co-op. They don't have the requisite kind of recording in place to be compliant with what the expectations of that intersection with the business as usual economy is. And because they've rejected fully, being in contact with financial systems, they find themselves in a difficult spot. How's this tracking for your observation, Sean? Before we get to you asked a great question. What level of are we talking about? But I think the preamble is important. Financial systems can feel icky.
Oh, yeah. Well, we're getting there. And yeah, this resonates deeply for me. And, very vulnerably, I can share that as a young entrepreneur in my early 20s, I did not do any bookkeeping for years. I mean, and it is shocking how I could survive, but I was getting cash deposits and putting expenses on credit. And then I don't remember how many years in, but I remember at some point actually doing some accounting for a calendar year that passed, and realizing that I had made something like $2,000 for the year. So I kind of, was on the avoidance side of things, and then realized how that was affecting, my life and the ability to, grow and prosper in my business and career. And so then I got much more curious and interested in it. Right. So if avoidance is on one side, what's on the other side, and where are we trying to land with, the way we introduce this to our MBA participants?
Yeah, I think if avoidance is on one side, there's sometimes we'll meet entrepreneurs and co-ops and teams who say, I must, develop expertise. So for me to engage in financial systems, I need to know everything about, cash versus accrual, and, what the heck is every aspect of a balance sheet, and the different ways to calculate depreciation, and some of the details beyond just some basic fundamentals. And so what we usually guide organizations and teams to is something in the middle, where we say having universal literacy of financial systems across the organization is empowering and liberating, and enables a distribution of power, enables for autonomy and decision making, and opens up the possibility of things like open book management, which we'll talk about all in this session. And that literacy versus total competence. Now, somewhere in the organization, having the competence to be able to manage a chart of accounts, to be able to do your record keeping, and be able to prepare statements for review for compliance purposes, which we'll talk about in a moment, really important. So having some level of expertise somewhere, but that piece can be outsourced to competent service providers, professional services, or developed internally. But not everybody in the co-op, not everybody in the organization has to be an expert and have extreme competence in financial systems, but having a broad or universal literacy is what we tend to advocate for. Sean, how would you is there any elaborations, or am I making it clear enough?
Yeah, thanks. No, so we're aiming for literacy. And I guess the thing I want to underline here is you mentioned on the your introduction of, financial systems have and currently are used as a system of oppression, right? It's almost like a covert, lots of lingo and jargon and actual real consequences. And there's almost a mystique around it of, maybe only certain people that are really, either highly intelligent, experienced, educated, they're the ones who can understand this. And I just want to underline that is categorically untrue. And like you're saying, people have an intuitive understanding of this is an inflow, this is an outflow. And in fact, everybody manages their household income. Not to say, certain people don't have problems with that, but at the end of the day, we're talking about just simple, basic arithmetic, adding numbers, subtracting numbers, might be a little bit of multiplication, but it's really elementary mathematics. And it is the basic concepts are accessible. And so aiming for this universal basic literacy in an organization, it's not without process or procedure, but it's very achievable in terms of what we've seen. And one of the ways that can look is again, like you're saying, we don't need everybody in the organization to have complete competency, but we do need everybody to have enough literacy that you can ask good questions. Why is this reporting up this number? Why is this number down this month, et cetera? And then we can kind of drill down and get those questions answered. And that amounts to, governance and oversight that is accessible. So yeah, I just want to kind of affirm that if this feels scary and, I didn't do good in math and I don't know about numbers and stuff, just the basic concepts I think are accessible to folks. And that's one thing that we try to do in this training is support people in that level of understanding.
And for the purpose of this podcast, we can highlight some of those patterns that we kind of use in the facilitated training in the Next Economy MBA around financial systems that we find really useful for developing literacy amongst teams. One of the first things we talk about is kind of, how our accounting system used. And this comes kind of straight out of business as usual, but it's really important discernment for understanding where to put your attention in terms of developing literacy is the kind of use of accounting and financial systems for compliance versus like management or decision making or looking into the future. And that distinction can become really important because they oftentimes get conflated. So when people think about financial systems, they're thinking about their statements, the balance sheet, the profit and loss or income statement, cash flow, statement of cash flows, and so forth. And so they're really looking at some things that are oftentimes needed for compliance, whether it's when I say compliance, I mean like paying taxes, accessing finance or credit, certain types of reporting for other stakeholders that might be required. There's rules and expectations that are out there about how to report for that. And that's kind of in that compliance world. Whereas a lot of the emphasis for making decisions and understanding what's going on in the organization is more like on that, what we might call management accounting. And most of what the activities of accounting or bookkeeping are really recording the inflows, outflows, the transactions, and categorizing them into certain buckets. Those buckets happen to have, again, this the idea of a language. They have a name, and they're called accounts. And so understanding that there's a chart of accounts, like if we're talking to somebody who's just developing basic literacy in financial systems or a team and we're doing a training, we talk about like what are the buckets of how you would want to categorize information. And in fact, it's actually a pretty strategic decision to actually develop a chart of accounts that's understandable by the organization. We're at a point now where for many businesses and enterprises, co-ops, et cetera, they for double entry bookkeeping and maintaining a ledger, they'll use a software program, whether it's like QuickBooks or Xero, software as a service, something online if they have access to online. And those kind of oftentimes come with a boilerplate or a chart of accounts that is pretty standardized and are common. And the company and co-op will just use what the system has provided for them, which there is a shortcut or an efficiency there. But it's actually an interesting thing is like, are those buckets dues and subscriptions? Like, what the heck is dues and subscriptions? If that language of the chart of accounts doesn't make sense to the members of the company, you can change the labels in the chart of accounts to have it actually resonate with the language that is used in the company. So one of the first things is, and that's basically what a lot of accounting is, taking money went out or resources went out, resources came in. What bucket did that come from? And what bucket did it go into? And so knowing your buckets and your accounts and having labels that make sense can be one of the ways to expand literacy across the organization. Once things are categorized, of course, then there's some math that can be applied. And you can look at different periods of time. And if the chart of accounts, if the buckets are organized and the transactions are maintained through what we call bookkeeping, then these software applications that I mentioned, things like QuickBooks or Xero, allow for the generation of a series of financial statements that are useful for either compliance accounting or management accounting. Sean, anything I'm missing that from the beginnings of literacy and how we approach it?
Well, I like how you mentioned that there is a strategic element to setting up the chart of accounts, and we tie it into the design of the organization in terms of how the organization's designed into departments. And that can be strategic to then have the departments of the organization be associated with a chart of accounts, because then you can set budgets. For example, one distinction that we often make in an organizational chart is we create an area called culture, which takes what we see as the most strategic parts of what would be traditionally called HR, such as hiring, training, onboarding, performance enhancement. We take those out of HR and we put those high up in the design or strategy layer and say these are really important. So having a corresponding account in your chart of accounts for that can be, like you're saying, strategic and really empower an organization to think and behave differently and then account for that. So that's one example, and that would be considered management accounting as opposed to compliance, because you don't have to necessarily report on that example on your culture budget per se, but you don't have to report to the government or externally, but internally, that might be something you're tracking or even delegating to that team. Hey, you have your budget, manage your budget, everything's going to be fine. We'll just check it out on the report, make sure it's, below budget, and then we're good to go. So I think thanks, Kevin. I think that's a good intro to the distinction between compliance and management accounting. And so we're going to focus more on management accounting here. What are the time frames or time periods?
Sure. Yeah. So with these financial systems and the statements that correspond to them, there's kind of time frames to think about, which are useful in different ways. So a lot of accounting is focused on the past, the historical. It's like the tracking and reporting. What happened? So money or resources went out, money or resources came in, and let's look at what happened last month. Let's look at what happened last quarter. Let's look at what happened last year. Let's look at what happened the last 3 years, do some comparison. And it's useful for evaluation and analysis. And it's useful for developing an understanding of what happens, but that's all looking backwards. Then there's a certain, statements and information that gives us like what's happening now at this present moment. An example of that would be, looking at a cash flow statement or looking at a balance sheet, to name some of the forms. It's like, what is happening at this present moment? What's the state of the company at this present moment? And then there's very useful, and we'll talk about it as a special case, is looking into the future. And in some ways, I would say that's actually the most important for most next economy organizations, because most of them are going through a development or a growth phase. Appropriate growth to achieve their impact outcomes is they're looking at the future. And so having those buckets and the chart and actually using, guesses and assumptions and estimation and forecasting, prognosticating, looking to the future in the form of, a projection of the operations, and how that becomes in some ways the most useful tool for raising capital, for asking questions like what if, and doesn't have to be looking, there's so much uncertainty in the world, so looking out 5 years, 3 years, with a strong emphasis on what we think is going to happen in the next year. That's kind of the future looking tools. So we have past historical time frame, present, and then the future. And there's different tools and statements that we can associate with those time frames. Sean, do you want to go into like what some of those statements are? That's what we typically do in a facilitated training.
Yeah, so let's talk about some of the basic reporting. So this would be, mostly looking back or a historical period. One of the main reports that we look at is called profit or loss, or sometimes called income statement. And the way this works is there's a specific time period. So I'll name some typical time periods would be the previous month. So from the first day to the last day of the month, what exactly happened? How much money came in? How much money went out? In which of these accounts? And what's that? The proverbial bottom line, right? It's either profit or loss. So that's the profit or loss statement, P&L for short. And then of course, you could look at it a month, you can look at it a quarter, you could look at it a year. Those are typical time periods. And it gives us a sense of over that range of time, how did the organization do in terms of how much money came in versus went out? And of course, you are looking for some profit or some margin there. And this is, sometimes there's a misconception for how we emphasize businesses being purpose-oriented, that profit's not important. It's actually essential, right? If we don't have any profit, any surplus, any margin, there's going to be a lot of friction and challenge and stress in the organization. So while the purpose isn't to create profit, profit does enable us to function financially. We can run payroll, we can cover our expenses, and in fact, if there's surplus over time, then we can invest in, better benefits, we can invest in our supply chain, we can invest in all kinds of things. So very important statement there. And maybe you can help me here, because usually we do this with a visual medium, and we can actually look at the numbers and go through them and kind of discuss and answer questions. But here we are on
the podcast
and on radio.
Yeah.
I'm not sure how exactly to kind of go deeper.
Yeah. I don't think for the purpose of the podcast, we'd have to go that deep. But like you said, profit and loss, the income statement is really useful for kind of seeing the transactions categorized, understanding what happened. And we'll mention in a moment how it could be used in a management context when we talk about something called variance analysis. The balance sheet gives you that snapshot in time, a specific date and time that looks at the assets of the organization as part of that language, financial systems, and the liabilities and kind of the equity or kind of the ownership value of the company. And assets, you could think of those as like physical assets or cash on hand. So the cash in the bank account would be the asset. If your organization owns some equipment to do some processing or owns a vehicle fleet or a couple cars or a truck or whatever, that would be, on the asset side of the balance sheet. And then the liabilities are, maybe you owe some vendors some payments and they're going to go out in the next month or so, or you owe a bank or a lender some repayments or principal payments. Those would be the liabilities. And sometimes they're categorized as short and long-term liabilities, depending on when they're repaid. And then when the difference between the assets and the liabilities is considered the equity or the value in the company, equity used in that sense. I know that term means multiple things. So you can have, when your liabilities are, greater than your assets, then you actually have negative equity. The company, is that useful? Well, it's important for compliance stuff, and in certain cases where you're maybe looking to sell the company, or if it's important to track maybe the wealth created for shareholders in the form of equity, if the shareholders especially are the customers or the community or in the workers in a co-op sense, then having a way to track equity can be really important and useful as something to monitor. But the balance sheet in general, in most cases, we distill, when we talk about literacy, we kind of take pieces of the profit and loss statement and pieces of the balance sheet, the ones that correspond to the things that are most important to the impact of the organization, and we put them into something what we call like a dashboard. So you can still produce those statements for compliance reasons, whether you're trying to get insurance or you're talking to a bank or you're filing taxes, but having those statements boiled down to just a few of the key numbers that everybody in the organization develops universal literacy around to track. And which numbers should you use? It really depends on the impacts that the organization has set up in their impact vision. And that's it's hard, like Sean said, we go through examples in the facilitated learning experience, but it's hard to generalize too far because the things that are important to track are going to be different for each organization, though there are some patterns that we often talk about. Sean, do you want to mention anything about dashboards?
Hi there, it's Phoenix from Lift Economy team. We know that building a positive and effective workplace culture can be tricky, especially when it comes to tackling tough conversations and navigating power dynamics. That's exactly why I've created Culture Offerings, a workshop series designed to give transformational leaders and passionate individuals the tools they need to foster a more collaborative, equitable, and healthy work environment. Our very first workshop, Surfing Workplace Waves, is coming up on June 16th, and we've got plenty of other trainings lined up throughout the year. You can learn more about all of our offerings by checking out lifteconomy.com/culture offerings. Hope to see you there.
Yeah, thanks, Kevin. So those being the two main reports, but then the dashboard being a kind of a summarized or simplified, centralized way to look at it. Similarly, if you're driving a car, there's a lot of computers and all this stuff happening, but you need to know how fast you're going and how much gas you have, right? You just kind of like, what do I absolutely need to know? And that's how we develop the dashboard. But one of the ways we like to phrase this is the numbers tell a story, right? And so when we look at the dashboard, especially if we look at it with a team of, a leadership team or a team of co-owners or, whoever's in charge of the organization, what story are these numbers telling us over the, if we're looking at the last month, the last quarter, the last year, what's the narrative that's emerging here? Are we growing? Are we profitable? Are we hitting a downturn? And so this feeds into the management accounting because, when we're developing that literacy, we're looking at the dashboard, we're looking at these key metrics, and then we're asking questions and then using that to inform decisions. Hey, either everything's going great and just stay the course going forward, or we're doing better than we thought. Maybe we should hire, maybe we should expand, maybe we should launch a new thing, or we're hitting a slowdown. Where can we pull back? Can we cut expenses? So this is how we see those reports being used, right, as a management tool. What would you add to that, Kevin?
I'd say building off that. So when we have the management tools of a dashboard where you could have universal literacy developed across the team, so some type of open book management system where the team becomes trained on how to interpret the key numbers to get that story, that picture of health. So you could ask anybody in the organization, in the co-op, like, what is the financial health of the organization at this moment? And by looking at a few key numbers, at least they could tell a story of how things are going compared to some period in the past, last month, last quarter, last year. And that's important information. But then that corresponds to other parts of the dashboard and other systems that we find really important. One that becomes the lifeblood, especially for early stage organizations, is the kind of cash flow projection. And so cash flow corresponds to that, like balance sheet. Cash on hand, I mentioned, was one of the things in the balance sheet. So at that moment, how much do we have essentially in the bank that we could use to make payroll or to pay vendors? So it's cash. But then there's, of course, other parts that I mentioned in the balance sheet, like short-term liabilities. We actually might owe people, or we might have a payroll coming up. And of course, there's in the asset side, there might be accounts receivable, meaning like customers we've already done some work for them in some way, and we're waiting to collect. We're going to collect some money coming up. Well, that kind of cash on hand, accounts payable, and accounts receivable, at least in the near term, maybe even like on a week-to-week basis or looking at the next month, that becomes really important for early stage organizations which are typically cash constrained. And it's really paradoxical. We've worked with a lot of next economy organizations where they actually have done a lot of sales and they have revenue, they have income coming in. They haven't collected on it yet. And in fact, they may even had their biggest last quarter or their biggest month of like revenue, but we've actually seen them reach a point where they actually have to go into layoffs or they risk going out of business because they didn't have kind of the cash collected on hand, and some of the liabilities were piling up. And so cash flow management is really important in that universal literacy, to have some system for looking at, the next period. And that, again, it could be a week or it could be a month, and say, how much cash do we have now? How much cash do we think is coming in? And how much cash is going to be going out? And with a projection, you're looking for, of course, that place where like we run out of cash, or we dip below a reserve level that the co-op or the organization has said that we want to have, a certain amount of reserves in place to weather times when it's more difficult to collect cash from customers for whatever reason. And that kind of cash flow projection becomes part of the dashboard, because that's really important for the organization to know, like, oh, hey, we might not be able to make payroll. And rather than that being a surprise to everybody in the organization, which creates huge risk and ill will and creates a lot of stress for those people in the organization who are tracking cash flow, and they're seeing the risk and nobody else is, having kind of universal literacy and a view on cash makes it so that the impact of those types of scenarios where cash becomes really tight, and it's like, oh, we really need to collect from customers that can pay us, or we actually need to defer expenses, maybe even defer a payroll in this case of really early stage organizations that don't have enough reserves. Well, that lands a lot better for all the members of the organization. In fact, we've seen co-ops who will voluntarily be looking at the cash flow, and the membership will come to the conclusion like, hey, we should actually, furlough, or we should defer payroll for the next month. We know we're going to have cash coming in, but they make that decision collectively. When that decision is made collectively, it lands in a different way rather than when it's dictated from a boss or in a hierarchical, non-transparent way. So the dashboards that provide that level of transparency on cash flow can be really empowering for an organization in terms of its resilience. And, whether or not it's an actual co-op where it's owners, or it's a democratic organization that is practicing transparency and open book management, this view into cash flow, we would say, is like a critical success factor for developing and growing a next economy organization. John, anything you want to build on that?
Thanks for that example, Kevin, because that's one of the strengths we see of teams that are run this way, whether they're fully democratic or they're just highly affiliative and they're sharing information. They're actually able to weather economic downturns more resiliently than traditional organizations where information is obscured from the staff. And that relates, like, for example, just the last episode we did on Operations 1, we talked about organizational rhythms. And so there's a rhythm here around not just financial reporting, but cash flow. And ironically, right, the less cash you have, the more time you have to spend managing it.
Right.
So if you're in either you're in an early phase in an organization or you're in a tight period, you might have to have a tighter rhythm. Could even be daily or weekly that you're checking in on a cash flow. Ideally, it's more like a monthly, and you have some confidence that you can make it through the month. But it's one of those critical elements to manage here. That's what we want to see our organizations get to, is that it's a little more stable. It doesn't require such discrete.
And that's where collective management decisions that build up, internal cash reserves, as an example, can lead to that kind of foundational stability. And those management decisions can involve, things that typically are taboo, like compensation, where you can get broad agreement from the organization that we're actually going to manage cash in a way to actually build reserves so that we have more stability and resilience on an ongoing basis. Another tool that we use that hits the dashboard in a different way is the operating projection. And I want to say a few words about this because I think it's really important. Just working with a co-op, actually, recently, one of our clients, and they're really struggling with going into lean, operations and cash flow management. And they have great services that they provide and a good client base, and they're doing really important impact work, but they have yet to really develop a projection of what the next year or the next 3 years might look like. And there's a lot of resistance developing and operating a projection, something that looks out to the future, because that means you're estimating sales or revenue when you don't necessarily know how much you're going to sell, or how many customers you're going to get or how big those customers are going to be. And you're not sure exactly. You might have a better sense of how many people you're going to have and what kind of salaries or hours or expenses you might be, what those payments might be out. And people in many organizations is the largest expense. And you might have a decent sense for like how much your rent payment might be or how much other supplies might be. But the operating projection takes all that information of like, what's the average kind of pricing for a good? What's the average cost of a good or service? What's the compensation agreements that you have in place with staff or third-party service providers? And what are your overhead costs, your rent and other utilities and other things, regular expenses that you have? And what we advocate for is actually doing a month-by-month projection, best guess of what you think might come in and what you think might come out. And the real win for the exercise of building one of those forward-looking projections is actually to get better understanding of the assumptions that drive the organization. What do I mean by that is we've literally worked with Next Economy organizations when they kind of study for a moment what's called like the cost of goods sold or cost of services sold, like how much does it cost like in terms of cash going out for expenses to develop the good. And then they look at the price of the good, how they've priced it to the community, oftentimes trying to keep that price low to keep their goods accessible as part of their impact. They actually find when they actually organize their assumptions that there's not enough margin, the difference between the price that they're charging customers and clients and the cost in which they're producing the goods or services to actually be able to pay for the overhead. And so that's a really big dilemma, of course, and challenging. We've talked before in this series and certainly in the Next Economy MBA facilitated learning experience about something called the price paradox. And that's a challenging situation, but it's even more challenging if you don't know. And so just actually organizing the assumptions to be like, wow, what is the margin that we're looking at for the goods or services becomes a part of that operating projection exercise. But this co-op I was working with, not having a forward-looking projection or an estimate makes it so that it's difficult for them to manage their expenses. Because if I ask them, like, okay, they could say, here was our profit and loss, our dashboard from last month. I said, that looks really good. I think, is it good? What did you think you were going to spend? What was your plan? What did you guess? Your best guess? What did you? And they're like, we don't know. And so it's kind of like operating in a blind. So by having a forward-looking projection that kind of goes month by month out 3 years, there's a lot of unknowns, a tremendous amount of uncertainty there. But actually having a best guess, and that by being disciplined or rigorous enough to produce something that looks forward like that in a best guess, and by best guess, Sean and I usually advocate for, it depends on the stage of development. If you've been operating for a few years, usually your best guess could be within 10% on any given quarter or any given year or any given month. 10% higher or lower. That's what we're kind of aiming for. It doesn't always happen that way. The world changes, a lot of dynamism in the world, so you're not always within 10%. But if you have this forward-looking projection, then you could do something that also hits the dashboard, which is part of this universal literacy, part of this management accounting, part of this open book management, is you get what we call variance analysis. Variance analysis is what you think it is. It's here's what we thought we would spend or how much revenue we thought would come in. Here's what actually happened, and here's the variance, here's the difference. And looking at those differences gives a lot of good information about what might we need to do differently in the next period, the next month, the next quarter, the next year. And so the variance analysis could be done at different scales, but it gives a tremendous amount of information. And variance analysis could be done at a company level, at a team level, at a department level, depending on how your organization is structured. Each org area could have its own variance analysis, giving each org area the information they need to get better towards being within that like 10% or 5% variance. And the more tight that variance, the smaller that variance gets, the more, like Sean said, the more reliable, the more predictable the organization is. And we're not looking for perfect. And this is not like Wall Street compliance reporting of being with 1% within your earnings projection or something like that. The idea of having some stability and reliability to the operations of the organization allows you to focus even deeper on, hey, maybe we can we have enough cash reserve and we're fairly reliably operating this organization. Let's focus on some deeper impact initiatives. Let's go deeper in, what we're doing for the community or in our ecosystem restoration impacts from our supply web, or let's go deeper into, more community ownership of permanently affordable housing, or whatever the initiatives you have in the organization that are impact. You can go deeper once you have some level of reliable stability, and an operating projection helps you get there. Sean, anything you want to say about the operating projection and variance?
Yeah, you mentioned you could evaluate variance in different areas of the organization. The other example we see is on projects, especially if the organization has revenue-based projects that are customized, especially in a lot of industries. For example, you'd have to bid in advance of how much you think a project's going to cost. And then we want to see how much did it actually cost, right? And which areas matched up or didn't. And like you were saying, just on having that tighter variance is a confidence builder for the company in general. This allows you to confidently, price your products or services into the future, knowing that you can accurately project what it's going to cost you. So that's an application that we see for variance analysis. The other thing I was going to mention is just in terms of how do you do an operating projection, whereas you mentioned for some of the historical accounting and the bookkeeping, there's often teams are using a software platform that does that. But when we're looking at cash flow and operating projections, oftentimes I think there are some tools developing that are getting better. But for example, for our team and a lot of the teams we work with, see this mostly being developed just on spreadsheets, just, programming your own spreadsheets. So I will mention that this particular element is a little bit more difficult. And like you said, there's some courageousness involved of, hey, what are we going to do 3 years out, and being able to have some uncertainty. And there's also just kind of a lot of details that have to go in there. So it is a tool, for example, when we're working with a company, sometimes they don't have this tool at all, just because people on the team don't have the experience or the ability to build this. So it is a little bit more advanced tool. But I will say it's well worth the effort, because if we can takes maybe like 8 or 10 hours or something on average to build out, a fairly functional operating projection. And of course, you have to use it over time for it to get really tight. And you can see the variance analysis proving that it's working. But boy, that's a lot less energy than actually just seeing how things go for a few years and then adjusting historically, right? So if we can do some math in advance and run some scenarios and say, hey, well, what if our pricing was like this? And ooh, okay, we won't cover costs. Well, what if we can switch out?
What if we hired this person, or what if we did this?
Yeah, hiring.
What if we lowered our prices to make them more accessible, right? Yeah.
Lower our prices, maybe where there's another location we're going to open. There's all these scenario plannings that we can go into. So we want to have a tool that lets us model these out reasonably accurately, so we can see in broad strokes of, hey, this looks like it might work, or there's no way this is going to work. And that's just way more effective than actually just trying it over time. So yeah, to sum up, is even though there's some difficulty involved, it's way better than the consequences of making a bad decision and not realizing it until it's maybe too late.
And building on that, in the Next Economy MBA facilitated learning, of course, we do have some templates available. They're fairly generic as possible, to be adapted to each specific situation, and we can help with that in the training, and oftentimes do help adapt them to specific situations for organizations. So building back towards this management and open book management accounting. So having an operating projection that looks forward, which is also, for what it's worth, might be required by, many times when accessing investment capital of different, even from the community or from some institutional investors or a bank, having a forward-looking projection is usually required, a prerequisite. So it's not only useful for the team internally, it can be important for accessing credit or finance. And so you have that forward-looking projection, so you can do that variance. Here's what we thought would happen. Here's what actually happened. Here's the difference. That becomes part of the dashboard, part of the literacy at different layers of the organization. And so now the dashboard becomes this literacy tool. You have kind of the health or the story of what's going on in the organization using some of the information from the profit and loss statement, some of the information from the balance sheet. You have kind of a cash flow projection. How are we doing in terms of the next little bit here in terms of cash flow? Are we going to be okay? And then you have some of this variance analysis to inform what needs to change, what's going to be different. And of course, all those systems need to be updated and maintained, like Sean said, on some regular periodicity, depending on the, quote unquote, maturity or stage of development of the organization. So like Sean said, with cash flow, the more cash flow is fluctuating or the tighter the cash flow is, the more time, the quicker the cadence or rhythm of iteration and kind of change. The more stable things are, the less iteration and change needs to, the less energy you need to invest in these types of systems. The one thing that I would just add that is honestly an area for innovation that Lift Economy is researching pretty heavily is when we look at dashboards. So far, we've been talking a lot about financial information, transactions, cash going out, cash coming in. There are, of course, for the impact vision and mission of the Next Economy organizations, there's a lot of there's a lot of other impacts that are not, cash. And so, this could be community members housed or hectares of ecosystem restored. And those critical impact metrics also could be tracked in the same systems, especially the dashboard and the operating projection. And that allows for this area of innovation that we're looking to develop more, is a way to develop more interesting quote unquote ratios or information that really emphasizes the impacts that we want to have. We've seen some different things, wealth created for community members per transaction. We've seen things like, water for conservation hydrology, data points about the impact of an organization based on the expenses of the organization. So you take a financial piece of information, you take an impact piece of information, and you can put them in ratio to each other. And that could become something that you want to improve over time. It's like we want to have more hectares of ecosystems restored for every dollar of revenue we create from the sales of our tea or whatever it is. And those ratios, those impact ratios, are something that we're working on to develop more easily customizable impact metrics, because obviously the financial health and the sustainability of an organization enables it to achieve those impacts, to become a going concern, to just continue on its important work in providing those needed goods and services. But there's critical information that you could get and make important management decisions based on the impacts that the organization is creating and how those correlate with the sustainable financial health, if you will, of the organization. And right now, even at large scales, there's different large scales, meaning in the public equities, publicly traded companies. There's different compliance initiatives for getting people to report on greenhouse gas emissions, scope 1, scope 2, scope 3 emissions, et cetera. And we think those are interesting. For smaller companies, there's less developed standards for how to report on impact for next economy organizations that want to share impact metrics within their company and externally, maybe to investors or other stakeholders. And so those are some systems that we're working on developing. And if you're listening to this and you're like, I have great ideas, or I've been doing that with my organization, please reach out to at least Sean or I or other members of the Lyft team. We're very curious to hear more case stories. We do have some good case stories that we reference in the facilitated training, but we're looking for more. Sean, anything you want to add on that last point?
Well, I definitely agree. It's an opportunity for innovation, right? It's to have the dashboard be more holistic in terms of representing the organization's impact than just the financial metrics, which of course are important in empowering and supporting our good work in the world. But it's another layer of depth to also summarize some metrics of exactly what impact we're having. So I think there's a lot to be developed there. So like you said, if folks are onto good stuff, please let us know.
Well, I hope that wasn't too much, or maybe it was too little. Of course, the facilitated training, we go a lot deeper into financial systems, and we're developing a self-study because there's been a lot of demand for expanding kind of the literacy amongst teams to be able to develop this kind of open book management culture. within the organizations that we've had the privilege of working with. And so I hope it wasn't too intimidating to click on a podcast about financial systems and operating projections, but hopefully we've shared that there's a right size level of attention there. Not everybody needs to be an expert, but there's some risk in, abdication or to ignore or to avoid financial systems altogether. So in that kind of middle balanced area, I hope this contributed to your efforts to create next economy organizations that work for the benefit of all life. Thanks for being with me, Sean.
Yeah, thanks, Kevin. Thanks, everybody.
Next Economy Now is a production of Lift Economy. To listen to all of our episodes, go to lifteconomy.com/podcast. That's LIFT economy.com/podcast. You can also sign up for our monthly newsletter at lifteconomy.com/newsletter. Please also rate and review our podcast on iTunes, Spotify, Stitcher, or wherever you get your podcasts. Thanks for listening.
Hi, Next Economy Now listeners. Erin here from the Lyft team. Have you ever asked yourself, how do I live an abundant life in integrity with the massive ecological and social crises facing our world? How do I feed myself, achieve personal security, meet my material needs, all while keeping in alignment with my values and working to build a world where others are able to get their needs met too? If so, we designed Next Economy Living for you. On June 9th, we'll be hosting our first ever Next Economy Living event. It's designed to be a conversation around how this journey of deepening personal security and resilience practices is deeply in harmony with a vision for a more just world. In this free 90-minute conversation, we'll discuss living minimally, saving resources collectively, and building food security block by block. You'll walk away with resources and templates to take the next step on your own journey, and a group of compassionate fellow learners to encourage you along the way. Are you ready to join us? Sign up today at bit.ly/nexteconomyliving.